Welcome to the podcast for this Monday, March 23, 2026. In this space for conversation and reflection, we explore current global events together, the stories you need to know. You can support this project via PayPal or through crypto by leaving a contribution in Bitcoin, Ethereum, or, if you prefer, Solana, now enabled. You can find the links and addresses in the description. Find US on your favorite platform: Spotify, Amazon Music, Apple Podcasts, TuneIn Radio, or YouTube. We're on almost every platform. Share our podcast with your friends.
And I have to say, what a week we are having. I mean, in the last 4 hours alone, we saw nearly $500 million just vanish into thin air.
Or completely gone.
Right, because of a single social media post.
Yeah.
And while retail traders were getting mathematically annihilated, sovereign nations were quietly dumping massive physical gold reserves just to, keep their domestic economies breathing.
Yeah, we are looking at a global operating system functioning with absolutely zero margin for error right now. From my desk on the investigative news side, the timeline we are tracking is a study in just unprecedented geopolitical brinkmanship.
Oh, absolutely.
We have starkly conflicting international narratives. We have open rebellion within the intelligence community, and a minute-by-minute escalation in the Middle East. It's real-time geopolitical maneuvering colliding head-on with a hyper-fragile financial system.
The stakes have rarely been this volatile, frankly. I mean, from a macroeconomic perspective, to quantify the sheer whiplash, we are currently witnessing the worst single week for physical gold since 1983.
Wow, 1983.
Yeah. And simultaneous to that, as I mentioned, a jaw-dropping $415 million was entirely wiped out in the crypto derivative markets in a matter of hours. And underneath all that surface noise, the foundational macroeconomic liquidity, the capital that literally lubricates the global economy, is actively decelerating.
Right. So our mission for this deep dive is to untangle this massive interconnected web for you. We are going to map out the factual reality of the current standoff between the United States and Iran.
Which is incredibly complex.
It is. We are going to dissect the historic market liquidation cascades that resulted from it. And then we're going to zoom out to examine how critical global infrastructures, everything from Middle Eastern power grids to Central American national security budgets to multi-billion-dollar corporate tech entities, are displaying severe systemic stress fractures.
And to really understand the financial carnage of March 23rd, you have to first establish the physical geopolitical spark, right? The thing that actually ignited the algorithmic trading bots.
Exactly. So let's build that factual timeline. The starkly conflicting reports hitting the news wires are the primary drivers of all this global anxiety you're seeing in the markets.
Yeah, the uncertainty is what kills the algorithms.
Right. So to understand where we sit today, you have to rewind to the late February escalation. The intelligence and military sources we track observed coordinated, highly targeted strikes by the United States and Israel on Iranian military installations. And the immediate ripple effect was not diplomatic at all. It was kinetic. We witnessed a series of severe reciprocal attacks on critical oil infrastructure spread across Qatar, the United Arab Emirates, and Bahrain.
And, the economic geography of those targets is absolutely not accidental.
No, not at all.
Those attacks directly threaten the physical viability of the Strait of Hormuz. And for anyone tracking global maritime trade, that specific narrow passageway is the primary artery for 20% of the entire world's oil production.
20%. Just going through one tiny choke point.
Exactly. When the Strait of Hormuz is threatened, maritime insurance premiums just skyrocket, tankers flat out refuse to transit, and the global energy market immediately prices in a massive supply shock.
Which brings us to the communications whiplash. Because for days, the international community has been bracing for a massive escalation.
Right, everyone was waiting for the other shoe to drop.
Exactly. Specifically, an ultimatum demanding the immediate opening and securing of the Strait of Hormuz, under threat of overwhelming force. But instead of military action, the market was handed a 5-day pause, announced unilaterally via social media.
Which nobody saw coming.
No. Let me read you the exact translation of the official Truth Social post from Donald Trump that hit the intelligence wires and temporarily shocked the global community.
Please do, because the wording is wild.
Yeah, so quote, "I am pleased to report that the United States of America and Iran have held, over the past 2 days, very good and productive conversations about a complete and total resolution of our hostilities in the Middle East."
Unbelievable.
It goes on, quote, "Based on the tenor and tone of these in-depth, detailed, and constructive conversations, which will continue throughout the week, I have instructed the War Department to postpone any and all military strikes against Iranian power plants and energy infrastructure for a 5-day period, provided the ongoing meetings and discussions are successful. Thank you for your attention to this matter." End quote.
So, in a traditional geopolitical framework, a diplomatic breakthrough announcement of that magnitude instantly de-risks the capital markets.
Okay.
You expect a massive, immediate sigh of relief across global asset classes, as the risk premium associated with a blocked strait just evaporates.
But the ink wasn't even dry on that digital post before the official Iranian denial hit the global feeds.
Minutes later.
Literally minutes. And it was a complete categorical rejection of the entire premise, citing the Iranian Foreign Ministry and their state news agencies. Their official diplomatic stance is, quote, "There is no direct or indirect communication with Trump."
Wow. Just a flat denial.
A flat denial. In fact, the Iranian claim completely flips the established narrative. They assert that the United States backed down solely due to back-channel counter-threats, that all West Asian power plants would be targeted in immediate retaliation if Iranian airspace was violated.
So you have two completely irreconcilable realities being broadcast to the algorithms and the public simultaneously.
Exactly. And the disconnect isn't strictly international either. It is actively tearing through the domestic intelligence and political apparatus in Washington.
The internal infighting is getting really loud.
It really is. We are reviewing assessments from former CIA Director John Brennan, and his analysis is incredibly stark. He publicly asserts that there was absolutely no verifiable intelligence indicating an imminent threat from Iran.
No threat regarding what, specifically?
Regarding ballistic missiles, nuclear capabilities, or regional terrorism. Nothing that would strategically justify invading Iranian airspace for a preemptive bombing campaign. He actually goes so far as to characterize the administration's justifications for the initial conflict as, quote, lies.
Man, that points to a profound structural fracture inside the White House intelligence briefing room.
Oh, absolutely. You look at the internal dynamics and the factionalism is obvious. You have cautious voices inside the administration, figures like J.D. Vance and Secretary of State Marco Rubio, reportedly calling the idea of a broader war ill-conceived based on the internal data. But then you have incredibly heavy, relentless external pressure from geopolitical hawks. Figures like Israeli Prime Minister Benjamin Netanyahu and media magnate Rupert Murdoch are aggressively pushing for a definitive military resolution.
That's a tug of war.
Yeah. And, we are maintaining strict political impartiality in this deep dive. We are not endorsing any of these geopolitical viewpoints or taking a stance on the raw intelligence itself. We are simply reporting the crosscurrents from the primary sources. But the picture it paints is one of absolute institutional chaos.
Complete chaos.
So, as a financial analyst, how does a rational market even begin to price in a war that appears driven more by external lobbying pressure and conflicting social media posts than by concrete, unified strategic intelligence? I mean, we are looking at a geopolitical poker game where the players are bluffing with live ammunition.
Well, the short answer is a rational market cannot price in pure chaos. It just can't. It can price in the probability of an event, but it cannot price in two diametrically opposed realities updating in milliseconds. What we saw on March 23rd was the financial ecosystem, specifically the highly leveraged crypto and derivatives markets, reacting to this exact poker game with unmitigated carnage.
Carnage is the right word for it.
It really is. It is a masterclass in modern financial fragility. Let me walk you through the mechanics of how this whiplash actually operated on the ground.
Yeah, I want to know the timeline. What did the actual trading tape look like the second that Truth Social post went live?
So you have to remember, algorithmic trading bots don't wait for human verification. They don't watch the news and think about it.
They just react.
Exactly. They read sentiment via APIs and execute in milliseconds. When the United States president's post about a diplomatic breakthrough hit the servers, the bots read peace. And Bitcoin, which had been consolidating around $67,500, violently surged. I mean, it tore through heavy resistance levels and spiked to over $71,200 almost instantaneously. The market aggressively priced in a de-escalation of global risk.
And then, minutes later, the Iranian Foreign Ministry denial hits the state news wires.
And the algorithms instantly flipped their directional bias. I mean, within moments of that denial crossing the news wires, Bitcoin shed $1,200 from its absolute peak. violently settling back down near the $70,000 mark.
That is just insane volatility.
And this wasn't an isolated asset movement either. We saw major layer one crypto assets like Ethereum, Solana, and XRP move in exact lockstep. They experienced these brief euphoric surges of over 4% before a vicious algorithmic pullback.
What about traditional markets? Were they caught in the same crossfire?
They absolutely were. United States stock futures jumped 2% on the peace narrative. But look at the physical commodities. West Texas Intermediate crude had briefly spiked over $100 a barrel purely due to the supply fears in the Strait of Hormuz.
Right, because of the blockade threat.
Exactly. On the news of the diplomatic pause, it plummeted back down to $85 a barrel. But, the spot price movements don't explain the systemic damage.
Right. You mentioned earlier that $415 million evaporated. How does $500 million disappear in a 4-hour trading window?
It comes down to the mechanics of leverage and forced liquidations. Think of the derivatives market like a suspension bridge designed for pedestrian traffic, and suddenly it's being forced to carry freight trains.
Okay, I like that analogy.
When you trade derivatives, you are putting up a small amount of collateral to borrow money and amplify your bet. In that 4-hour window, that $415 million wasn't just lost, it was forcibly liquidated by the exchanges. Let's do the autopsy on that capital destruction.
Yeah, break down the numbers for me.
First, $280 million in short positions were liquidated. These were traders who had looked at the geopolitical escalation, bet heavily that war was imminent, and shorted the market, expecting prices to drop.
But then the peace post happened.
Exactly. When the peace post triggered that massive price spike to $71,200, their negative positions went deeply underwater. And the exchanges do not wait for you to deposit more funds. Their automated risk engines forcibly close your position.
Ouch.
Yeah. And to close a short, the engine must buy the asset at market price. This forced buying pushes the price even higher, which triggers the next trader's liquidation point, creating a violent upward cascade known as a short squeeze.
So they get caught in an automated avalanche.
Yeah.
But the timeline dictates that the pendulum immediately swung back in the other direction.
Because the peace narrative was denied minutes later. So then, $135 million in long positions were liquidated.
The people who bought the top.
Exactly. These were the reactive traders who saw the initial spike, bought into the peace post using leverage, and got absolutely crushed when the Iranian denial hit the wires and the price dumped.
That is brutal.
It is. Looking at the asset breakdown of the destruction, $140 million was wiped out in Bitcoin and $120 million in Ethereum. But the most revealing macro story is the $64 million wiped out in Brent oil futures.
Where was that happening?
Specifically, the XYZ Brent oil contract on the decentralized exchange Hyperliquid, plus another $20.9 million evaporated in tokenized gold and $19.8 million in tokenized silver.
Okay, let me stop you on that oil futures detail, because from a purely logical standpoint, the traders shorting oil or betting against an immediate strike were actually correct. They predicted the outcome.
And that is the cruel, path-dependent reality of a market utterly dominated by derivatives. Right now, futures trading volume in crypto and tokenized real-world assets is roughly 5 times the volume of actual spot trading.
5 times? That's a massive ratio.
Massive. And leveraged positions turn a modest net price movement into a violent cascade. Those oil traders on Hyperliquid actually correctly predicted that the 48-hour ultimatum would pass without a United States military strike. They were 100% right about the fundamental geopolitical reality.
But their accounts were drained anyway.
Because they bet on the fundamental reality of the conflict rather than the social media reality of a delayed announcement.
Wow.
Yeah. In a highly leveraged environment, being fundamentally right but temporarily caught in a volatility spike is mathematically identical to being wrong. The exchange's risk engine doesn't care about your long-term geopolitical thesis. If the price spikes against you for 5 seconds and hits your margin threshold, your position is forcefully closed. You are removed from the market before your fundamental prediction can even materialize.
So while retail leverage is getting chewed up by this volatility, what does the data show regarding institutional capital? Because they aren't trading with 50x leverage on decentralized exchanges.
No, they're quietly acting as the counterparty to all this chaos. While retail leverage was completely wiped out, institutions with deep liquidity pools and no leverage requirements are accumulating spot assets.
They're buying the dip.
Exactly. According to market researchers, a firm named Moonshot just acquired 3,500 Bitcoin on the open market, officially becoming Europe's largest publicly traded Bitcoin treasury.
That's a huge acquisition.
Huge. And simultaneously, an entity known as BitMine acquired $138 million in Ethereum. And if you look at prediction markets like Polymarket, large-scale, well-capitalized traders are heavily weighting their capital toward a ceasefire. They are fading the algorithmic noise and betting on a reversion to diplomatic mean.
So the system is just hyper-reactive.
Yeah.
A single social media post triggers a $400 million liquidation earthquake, and a contradictory diplomatic denial triggers an immediate aftershock that wipes out the other half of the leverage.
That's a great way to put it.
Does this hyper-reactivity undermine Bitcoin's fundamental premise as a safe haven asset? I mean, if an asset can be so easily manipulated by a conflicting news cycle, how can anyone classify it as a safe harbor?
And that is exactly the debate dominating institutional macro desks right now. It forces a complete redefinition of what a safe haven actually means in the liquidity constraints of 2026.
We absolutely need to unpack that redefinition, and we also need to dive into the historic, fundamentally different crash we just witnessed in the physical gold market. But before we get to the mechanics of sovereign gold liquidation, a quick reminder to you, our listener, that you are listening to the deep dive into the macroeconomic and geopolitical fractures of 2026.
And if you find value in this deep, independent analysis of global systems, you can directly support this project. You can contribute via PayPal or through crypto by leaving a contribution in Bitcoin, Ethereum, or Solana. All the direct links and wallet addresses are located right down in the description.
All right, let's get right back to the data. We just outlined the extreme algorithmic volatility in the digital derivatives market. But you cannot evaluate safe haven assets without examining the historical benchmark, which is physical gold.
Right, the ultimate classic safe haven.
Exactly. And this past week, the gold market didn't just experience standard volatility, it experienced a systemic breakdown.
Breakdown is the accurate terminology here. We need to structurally analyze the shocking 11% drop in physical gold that occurred between March 16th and March 20th. This was gold's worst weekly performance since 1983.
The numbers are staggering when you lay them out chronologically. Walk me through the chart.
Okay, so in late January 2026, gold hit a monumental all-time high of $5,596 per ounce.
I remember that. The momentum seemed unstoppable.
Unstoppable. But then, as the specific Middle Eastern geopolitical crisis accelerated and the shipping lanes were threatened, the bottom simply fell out of the bid. The price violently broke down through major psychological and technical support levels.
It just crashed.
It crashed through the $5,000 mark, it shattered the $4,500 floor, and plummeted all the way down to $4,249.
Wow.
Yeah. And from a pure technical analysis standpoint, if the market cannot defend that $4,200 support level, there is virtually no historical support until a free fall down to $4,000.
You explicitly cited this as the worst week since 1983. As an analyst looking at historical market precedents, what is the parallel there? Why is 1983 the mirror for this current crash?
It's a fascinating parallel. If we rewind to the first week of March 1983, the gold market fell to $408 an ounce, dropping a massive 11.5% in a single trading day on February 28, 1983.
What was the catalyst back then?
The catalyst wasn't a rumor of war, it was a fundamental breakdown in the mechanics of the global oil market. OPEC was forced to accept massive price cuts due to a severe global oversupply of crude oil.
So the petrodollar revenue essentially dried up for the Gulf states.
Exactly the mechanism. Sovereign states like Saudi Arabia and Kuwait suddenly found themselves lacking physical United States dollar liquidity to fund their massive domestic operations, infrastructure projects, and government budgets.
Right.
So what does a sovereign nation do when it desperately needs dollar liquidity and its primary revenue stream collapses? It is forced to sell off its accumulated physical gold reserves on the open market to raise that cash.
And when sovereign wealth funds dump massive tonnage onto the open market, it overwhelms the bid-ask spread and crushes the price.
Precisely.
Which brings us perfectly back to the 2026 catalyst. The geopolitical trigger today isn't a global oversupply of oil. It's a physical kinetic blockade. With the Strait of Hormuz effectively blocked or highly threatened by this United States-Iran standoff, Gulf states like Qatar, the United Arab Emirates, and Bahrain simply cannot export their oil via maritime routes.
That is the critical physical bottleneck right there. It does not matter that the spot price of oil briefly spiked to $119 a barrel on the panic of a supply shock.
It doesn't matter at all.
Right, because if you physically cannot load that crude oil onto a tanker and sail it through the Strait of Hormuz, you cannot deliver the product, and therefore you cannot get paid. The sovereign cash flow stops entirely.
Here is the paradox we are looking at from an investigative standpoint. For the last few years, these major oil-producing states have been aggressively hoarding physical gold.
Oh, massive amounts.
Right. Ever since the global financial community saw Russian sovereign assets frozen by Western powers back in 2022, central banks globally recognized the danger of holding United States treasuries. They began buying physical gold in massive quantities to protect their national wealth from potential sanctions.
True.
But now, the very geopolitical crisis they were mathematically protecting themselves against has physically cut off their maritime revenue, forcing them to liquidate that same gold just to survive and keep their domestic power grids running.
It's a brutal, inescapable feedback loop of liquidity. One of the prominent financial experts in our research provided an analysis that distills this perfectly. He states, quote, "When the crowd that drove the rally needs liquidity, they sell what they own. Gold was first because it was up the most."
That makes total sense.
He makes a vital macroeconomic point here. Physical gold being priced at $5,500 earlier this year wasn't actually a reflection of pure underlying systemic safety. It had become a crowded, speculative macro trade driven by sovereign actors hoarding ahead of a crisis.
And when the crisis actually arrived, the buying completely stopped. The institutional data backs that up, doesn't it?
Radically so. Central bank gold buying had been running at a massive average of 27 tons a month globally. It was a relentless bid under the market.
And now?
In January 2026, as the regional tensions escalated and budgets tightened, that buying plummeted to just 5 tons.
That is a massive drop-off.
And furthermore, you have to factor in the broader fiat environment. The United States Federal Reserve is maintaining a highly hawkish stance.
Right, keeping rates high.
Exactly. Meaning they are keeping interest rates aggressively high to choke off spending because they are terrified of this energy-driven supply shock reigniting domestic inflation. High interest rates make non-yielding assets like physical gold inherently less attractive to hold. So you have massive forced sovereign selling pressure colliding with a complete evaporation of central bank buying.
Let me challenge the fundamental premise of gold based on this data. If sovereign states are dumping their so-called safe haven physical assets at fire sale prices just to keep the lights on and fund their governments during a regional naval blockade, does the traditional definition of a reserve asset even apply anymore?
That's the million-dollar question.
And if your safe haven only retains its value when the global maritime supply chains are open and functioning normally, is it actually a safe haven or just a luxury commodity?
And that is the defining macroeconomic question of this decade. And it perfectly transitions into the broader macro liquidity picture we need to analyze, because we are witnessing a historic real-time divergence between how the market treats physical gold and how it treats digital alternative assets like Bitcoin.
Let's dig into the mechanics of that divergence. What are the distinct structural use cases for these two assets in 2026?
According to a deep structural analysis from a major crypto research firm detailed in our sources, Bitcoin and gold are officially taking divergent paths. They represent two completely distinct buyer segments operating with entirely different motives and facing different physical constraints.
Okay, lay it out for me.
Gold is heavily driven by central banks acting on grand geopolitical strategy. It remains the preferred physical asset for state actors who want to store massive amounts of national wealth completely outside the digital reach of rival superpowers. In an era of deteriorating international relations and weaponized banking networks, physical gold in a domestic vault is sovereign insurance.
But Bitcoin represents a different kind of insurance, operating on a different axis of risk.
Precisely. Bitcoin is driven largely by individuals, retail investors, and increasingly corporate treasuries who require immediate, unblockable settlement. It serves as an alternative financial lifeline, particularly when local physical banking systems completely fail or are targeted.
And we have a concrete, terrifying example of that localized failure in the geopolitical reporting. Following the Iranian missile and drone attacks in the Gulf, both the Dubai and Abu Dhabi stock exchanges were completely shut down.
Wow. Just entirely offline.
Completely. The physical servers, the localized digital infrastructure, and the clearinghouses of finance simply stopped operating.
Right.
In kinetic warfare or in severe regional emergencies, you cannot walk down to the bank and withdraw physical gold, nor can you easily transport it across a closed border.
Right.
But Bitcoin's decentralized, globally distributed, 24/7 accessibility proves invaluable when localized traditional infrastructure goes offline.
It's the fundamental difference between static sovereign wealth storage and individual kinetic liquidity. You can't cross a border with $1 million in gold bars. You can cross it with a memorized seed phrase. But to understand the future trajectory of both of these assets, we have to look at the global ocean they swim in, which is the M2 money supply.
Let's clearly define what we mean by M2 in this context and look at the underlying data.
Think of the M2 money supply, like the overall water pressure in a massive city's plumbing grid. M2 is a broad macroeconomic measure of all the fluid money currently circulating in the global economy. It includes physical cash, checking deposits, and easily convertible near money in savings accounts.
The actual spendable liquidity.
Exactly. It is the ultimate measure of global systemic liquidity. When the pressure is high, water easily reaches the speculative assets at the very top of the skyscraper. Right now, that overall water pressure is decelerating. The global M2 money supply growth has shrunk dramatically. We were previously looking at a $15 trillion year-over-year expansion, and that has now dropped down to a $12 trillion expansion.
So the central banks are still printing, the system is still expanding, but they have significantly pulled back the throttle.
Exactly. The growth is still positive, but it is losing momentum rapidly, especially entering the period after the 2024 Bitcoin halving, which traditionally requires massive liquidity to sustain price appreciation. Historically, this deceleration is a massive warning sign for risk assets.
Because there's less fuel for the fire.
Exactly. When M2 year-over-year growth actually turns negative, which we saw during the tight monetary periods of 2014 to 2015 and again during the brutal market crush of 2022, it perfectly aligns with massive, prolonged Bitcoin bear markets. The global market simply has less surplus capital available to throw at risk at investment vehicles.
But there is a fierce counter-argument to this inside the financial community, right? Relying solely on the broad M2 metric might be a flawed methodology in 2026.
It might be. A leading market expert we track offers a very compelling counter-framework. He suggests that we shouldn't just look at broad M2 because M2 includes money just sitting idly in savings accounts not participating in the markets.
Dead money, essentially.
Right. Instead, he argues that United States Treasury bill issuance is a far more accurate and immediate predictor of Bitcoin's price action.
Why is that?
Because Treasury issuance reflects the actual kinetic capital actively flowing into the hard financial system. When the United States issues short-term debt, it fundamentally alters the immediate liquidity available to institutional investors.
Which brings us to the great macroeconomic debate happening right now among the top financial minds in the world. You have two heavyweights looking at the exact same macro data, the exact same geopolitical fractures, and coming to entirely opposite conclusions about the future of money.
We do. On one side of the aisle, you have prominent macroeconomist Lynn Alden. She argues that the financial pendulum is going to swing aggressively away from analog systems and that Bitcoin will vastly outperform gold over the next 3 years.
And her reasoning.
Her thesis heavily relies on the diminishing returns and physical constraints of gold in this specific cycle, exactly like what we just saw with the Gulf states. On the exact opposite side, you have billionaire former hedge fund manager Ray Dalio. He argues that Bitcoin will absolutely never replace gold as a true foundational reserve asset.
Interesting. What's his argument?
His structural reasoning is that Bitcoin still behaves and trades exactly like a highly leveraged tech stock risk asset. It is too volatile for central banks. Gold, despite its recent crash, is fully, fundamentally entrenched in the regulatory architecture and balance sheets of the global central banking system.
So if I can use an analogy here to synthesize this, gold is the reinforced concrete bunker for governments. It's heavy, it's hard to move, but it is recognized by every state actor. Bitcoin is the high-speed life raft for citizens and corporations who need mobility.
I love that analogy.
Thanks. But if the global ocean of liquidity, that M2 water pressure, is actively drying up, do both the bunker and the life raft eventually just hit the ocean floor?
Well, if liquidity completely dries up and we enter a severe deflationary spiral, yes, every single asset correlates to one on the way down, cash becomes the only king. But it is not just the digital derivative markets or the gold vaults that are hitting the ocean floor right now. The severe stress we are seeing in the capital markets is merely a reflection of the deep structural stress in the physical world.
Yeah, the liquidity drying up doesn't just crash Bitcoin. It breaks physical sovereign states and corporate entities. It is all deeply intertwined. When we dig into the primary sources, we find that domestic budgets, physical infrastructures, and corporate structures worldwide are showing undeniable signs of buckling under the pressure of this macro environment.
It's happening everywhere.
It is. Let's look at 3 separate global stories from our sources that highlight this exact systemic vulnerability. I want to start with the fiscal realities on the ground in El Salvador.
The current situation in El Salvador is a fascinating, extreme case study in macroeconomic trade-offs and sovereign debt.
Let's lay out the facts. We have a detailed report regarding the findings of an international group of human rights experts. They're actively analyzing El Salvador's prolonged state of exception, a legal framework that suspends certain constitutional rights to aggressively combat gang violence.
Right.
Now, setting aside the complex human rights debate to remain strictly impartial and focus entirely on the data, the physical and fiscal realities of this policy are undeniable. The nation's prison population has exploded, exceeding 100,000 inmates since 2022. Consequently, state security spending has seen an absolutely unprecedented vertical surge.
And as a financial analyst evaluating sovereign risk, looking at the trajectory of these budget numbers should set off immediate blaring alarm bells regarding debt sustainability and yield curves.
Let me give you the exact figures extracted from the national budget reports. The total security, defense, and penitentiary budget almost doubled in just a few years. It jumped from $557 million in 2019 to $1,047 million projected for 2025. That is a 95% increase in non-revenue generating spending. If we drill down into the specific departments, the penitentiary budget alone jumped 150%, scaling from $56 million to $140 million to handle the massive influx of inmates. The Ministry of Security budget doubled from $310 million to $617 million. National defense grew from $191 million to $309 million.
And we have to account for the physical infrastructure cost of maintaining this policy, too. The sources explicitly detail the CE-COT maximum security prison in Tecoluca. The government budgeted a massive $135 million just for the initial construction rights of this single mega facility.
That is an enormous capital expenditure.
Additionally, the report notes a severe lack of operational transparency regarding the inmate transfer criteria to this prison.
From a purely investigative reporting standpoint, that lack of transparency is a massive blind spot for civil accountability. But looking at it through the lens of a sovereign balance sheet, what is the underlying macroeconomic danger here for El Salvador? I mean, where does the money come from?
The danger is that this explosive exponential level of spending is fundamentally mathematically unsustainable over the long term. You are pouring over $1 billion annually into a state security apparatus. While security is obviously necessary for a functioning society, a prison system does not generate economic yield. It is a permanent sinkhole for capital.
Right, there's no return on investment there.
Exactly. This creates immense crushing pressure on public finances. And this fiscal expansion is happening in a country that is already historically struggling with low domestic economic growth and highly restrictive external debt obligations. They are essentially leveraging their entire national balance sheet and issuing high-yield domestic debt to fund a single internal security strategy.
It sounds incredibly fragile.
It is a financial system under extreme unyielding tension. When that debt eventually has to be rolled over in a high-interest rate environment, the math just breaks.
Which mirrors the physical tension we are seeing in critical infrastructure globally. Let's pivot from the sovereign financial vulnerability in Central America to the physical grid vulnerability in the Middle East and the United States.
Physical infrastructure is truly the soft underbelly of modern digitized civilization.
Let me quote Shaul Goldstein, the CEO of Noga Energy, which operates as Israel's independent national grid operator. He was asked point blank in a recent interview about the physical readiness of the Israeli power grid in the event of a full-scale regional war in the north.
What did he say?
His response was chilling in its stark honesty. He said, quote, "After 72 hours without electricity in Israel, it will be impossible to live here. We are in a complicated situation, and we are not prepared for a real war," end quote.
That is a terrifying admission, but it directly ties back to the geopolitical realities we discussed regarding the United States and Iran. Energy infrastructure isn't just accidental collateral damage in these modern conflicts. It is the ultimate primary geopolitical target.
Right.
Modern finance, communication, and water purification rely entirely on electricity. If a state actor can knock out the regional grid for 3 days, they don't need to defeat a military on a traditional battlefield. The entire civilian society simply stops functioning.
And it is not just in active geopolitical conflict zones where critical infrastructure is failing. We have a tragic, deeply concerning report out of the United States highlighting domestic infrastructure failure at the highest levels of aviation.
The incident in New York.
Yes. An Air Canada passenger plane collided directly with a fire truck on the active runway at LaGuardia Airport in New York. The collision was catastrophic. The entire airport, one of the busiest hubs in the world, had to be completely shut down, leaving 2 people dead and over a dozen injured.
It proves that even the most heavily funded, technologically advanced, and strictly regulated logistical hubs in the world are suffering from catastrophic operational breakdowns. The systems are just stretched too thin.
Which brings us to our final example of systemic vulnerability. The massive corporate vacuums appearing in the multi-billion-dollar tech sector. We have an unexpected and structurally massive disruption regarding the ownership of OnlyFans.
This specific case is a textbook study in key person risk and extreme corporate leverage in the digital economy.
Let me set the scene. The primary sources report the sudden passing of Leonid Radvinsky, the 43-year-old owner of OnlyFans who tragically died of cancer. Radvinsky was not just a passive shareholder, he was the absolute center of gravity and the sole visionary for that platform. He bought a majority stake back in 2018 and built it into a digital juggernaut.
And the financial mechanics of his sudden absence are staggering. I mean, Radvinsky had personally paid himself $1.8 billion in dividends since 2021, draining massive amounts of cash from the company.
Wow, $1.8 billion.
Yeah. But more importantly for the macro picture, at the time of his unexpected death, he was actively in the middle of negotiating the sale of a 60% controlling stake in the company to a private equity firm called Architect Capital.
Let's look at the valuation numbers on that specific deal because they are massive.
We are talking about a complex, leveraged buyout agreement that valued the overall platform at an astonishing $5.5 billion. But here is the critical systemic detail that analysts look at. That buyout was going to be loaded with $2 billion in structural debt.
Walk me through how that debt mechanism actually works and why his death threatens the entire structure.
Sure. So in a leveraged buyout, the acquiring firm uses a massive amount of borrowed money to meet the cost of acquisition. The assets of the company being acquired, in this case, the projected future cash flows of the OnlyFans platform, are often used as collateral for the loans.
Okay, so they borrow against the company's future earnings.
Exactly. The lenders provide that $2 billion under the strict assumption that the visionary founder who built the cash machine will help transition it. Its passing doesn't just leave an emotional void, it introduces a massive, unquantifiable risk premium.
The lenders must be panicking.
The creditors suddenly look at a highly lucrative but highly controversial tech giant now missing its central architect, and they balk. It leaves a massive ownership and leadership vacuum at the exact moment the company was undergoing a highly leveraged structural transition. It is the definition of corporate fragility.
When I pull back and look at all these pieces on the global board, whether we are looking at a deeply fragile, unready power grid in the Middle East, an over-leveraged and exponentially exploding security apparatus in Central America, a deadly, unthinkable infrastructure failure on a major runway in New York, or a sudden massive leadership void in a multi-billion-dollar leveraged tech buyout. The recurring theme of 2026 becomes absolutely inescapable.
Everything is redlining.
Everything. Our systems, whether they are maritime shipping lanes, algorithmically driven derivative engines, sovereign bond markets, or domestic infrastructure, are stretched to the absolute breaking point. There is zero margin for error left in the global operating system.
That is the ultimate unifying takeaway from this entire analysis. Every single data point is deeply, intricately interconnected by the underlying flow of liquidity and risk. Today, we mapped out the exact mechanics of how a single, conflicting geopolitical rumor regarding the United States and Iran can algorithmically liquidate $500 million in crypto derivatives in 4 hours.
Just a staggering amount of money.
We detailed how a physical blockade in a Middle Eastern strait can completely sever sovereign cash flows, forcing wealthy nations to dump their physical gold reserves and triggering the worst crash since 1983. And we explored how the foundational fragility of global liquidity, that decelerating M2 water pressure, makes all of these physical systems, from El Salvador's national budget to massive tech buyouts, incredibly vulnerable to any sudden, unexpected shock.
It is a massive amount of systemic data to process, but that is exactly why we do this. We want to thank you for taking this deep dive with us today into the complex realities of 2026. As a final reminder, if you value this independent, data-driven analysis of global events, please consider supporting the project. You can contribute via PayPal or through crypto by leaving a contribution in Bitcoin, Ethereum, or Solana. All the links and addresses you need are right there in the description.
And before we officially sign off, I want to leave you with one final provocative question to ponder as you look at your own investments and the shifting world around you. If powerful, historically wealthy sovereign nations are being forced to liquidate their physical, safe gold reserves at fire sale prices just to physically survive a regional naval blockade, what does that practically mean for the future concept of a safe haven asset?
It really makes you rethink the fundamentals.
It does. If true financial safety in the 21st century requires instant, unblockable, borderless liquidity regardless of physical kinetic wars, perhaps the ultimate reserve asset hasn't even been properly defined by the market yet.
A truly fascinating structural thought to leave us on. Thank you again for joining us, for analyzing the hard facts with us, and for supporting independent investigation into these critical systems. We will be back soon with another deep dive. Stay informed, stay curious, and take care.
Goodbye, and thank you for listening.